Hi guys, so I am in Liverpool today. I'm going to meet an investor I know called Joe. I met Joe quite a few years ago now when we were both starting Airbnb businesses. He's now got two business partners who he does lots of different stuff with. So the main reason I want to speak to Joe is to pick his brain on how to use investor finance, because that's one of the ways me and my brother want to try and scale our property portfolio. So yeah, I'm gonna pick his brains, and hopefully, if he's not camera shy, I can record it. One of the main reasons I came to speak to Joe today is to talk around like using investor finance. So we're in the process of buying our first buy to let, and it's speaking to Joe about how he structures different deals. So he does the difference between GAV deals and investor finance deals. So maybe if you just talk about how you structure a GAV deal and how you structure just a straight investor finance deal. If you don't mind, mate.
Yeah, no worries. So, a joint venture deal, the way we structure it is first comes with a conversation, and both of them they come from conversations and relationships. The way we structure networking again. So you find your joint venture partners through networking and social media, just being active. The next step then is just really setting like kind of heads of terms of what what you believe the goal of the company is. So I have some joint ventures where we're going to be buying and holding for the long term for rental income. Other ones we've just set up, we haven't purchased yet, are going to be for flips. So the structure of it is we'll have our company, we'll set up a special purpose vehicle. 50% of those shares will be owned by our holding company, and the other 50% of the shares will be owned by the joint venture partners, either company or their personal name. So yeah, we'll have a shareholders agreement. It'll outline all the different scenarios of what qualifies a good deal, what we're looking for,
Yeah.
how the finance is repaid, like who's like voting rights, different things like that.
Okay.
You talk about different who holds whatever voting rights.
So it's like just to clear. So
Yeah.
voting rights is like if you were to make a key strategic decision within the company, it'd be like who gets weighted.
So here's an example. So our company, we have three partners. So there's three directors ourselves, and then a joint venture partner is one person.
Yeah.
So we as a collective, because we own 50% of the shares, we have I have one voting right, and Mark and Justin have one voting right as well. Whereas our joint venture partner has three. So it's equal. So we're keeping it equal that way. We also have a caveat in it as well. Within £5,000, if whoever has the more money invested within the company, then they get the final say basically on a decision, which we think is fair.
Yeah.
We have other things as well, like we factor in as well. So if you're buying and holding, you really want to make sure that you're on the same page with the investor that you're working with.
It's going to be a long-term relationship.
Yeah. If it's a flip, it's okay because it's like a clear in and out. Whereas if you're buying and holding, you want to be very kind of specific on the what ifs. Classing like what is considered a bad deal, what's a bad deal clause, things like if the return on capital left in after refinance is below a certain percentage, then you look at maybe selling as an exit to benefit shareholders' best interests, to be able to reinvest in a better deal. Things like that.
What about stuff like death? Does that
So death. So basically, the share can stay with the estate, but they don't have a right to the board votes.
Yeah.
So that's what we have in that. So so the state would own that shareholding, but they wouldn't have a seat on the board. So that's what we have in the ones that we currently have. And then other things as well, to review the market every 5 years, or if there's any major shifts in the market, to review, right, are we better off holding now or should we sell? Is it better now? Is it a tactical thing to do to actually sell now? Say like there's massive like huge bull market, values have gone up massively. Are we better cashing out a little bit?
Taking some profit,
Yeah, take a bit of profit out. Maybe not refinance again because then you're over geared and it might be a bit risky if the market crashes and the lender comes along and says, right, well, you're now 90% loan to value when you should be 75% loan to value. Give us our 15% equity or else we're taking the house. So you don't want to be over geared either. So it's a balance. So that's so for the joint venture. So that's a shareholders agreement.
Yeah.
Then the separate agreement we have is the loan agreement. So that's the loan agreement between the director. Either they're doing a company loan into the SPV, the special purpose vehicle where you're buying the assets in, or they're doing company loan or a straight director's loan if they have it in their personal name. So that's basically outlining everything from what the purpose of the loan is for. If you decide an interest rate, you can put that in there as well.
So just to give context as an example, it might be you found a buy-to-let deal.
Yeah.
That you want to use investor funds to purchase. So let's say purchase price is 100 and you think you're going to spend 20 grand on the refurb. So you're looking for an investor to lend you £120,000.
Yeah.
So that'll be a loan from them to you as a direct to the business. Sorry.
To the SPV.
Yeah, to the SPV. And then in the heads of terms, it would stay payback term.
Yeah.
And you guys normally do 12 months.
Yeah, I mean, if you're doing like a fixed rate return, like if someone's like lending you money, then you probably would do like a 12-month term.
Yeah.
And then it'll either be monthly payments or it'll be wound up at the end on your exit, either when you're selling or if you're refinancing.
So in this instance, it'd be at the end, wouldn't it? Yeah.
At this instance, it's basically on refinance. So there's no like definite, term. It's basically they get paid back the majority of it on refinance. Now in today's market, if you can't get all the money out, we have it written in that any profits from the business go to pay back the investor first before we take any profits. So any of the net profit after management, after any of the costs or whatever, they get all the money back first. So say in this example, 100k is purchase price, the refurb was 20k or whatever, and whatever finances back up to be whatever the end value. If it leaves 10k in the deal, that 10k profit or 10k that's owed back to the investor, that will come back out first before we take any profit, and then everything after that then is 50-50. So that's the way we'd work.
And so it'd be 50-50
on the both the equity increases, on the profit, like the equity, and also the rental income.
The rental income, and that's a JV and the loan agreement. That's like the mix.
Yeah. So the loan agreement would have been satisfied. That would have been that loan would have been paid back. The majority of it on refinance. So they're getting the biggest. Say they put in 120 and they're getting 110 back. So they've only 10k left in it. So they still have that majority of their capital back within whatever 6 months, 9 months, however long it takes to do the refurb. And then after that, then they can decide to go again. Put that money into another deal or do whatever they want, buy crypto or buy a car or whatever.
Yeah. Nice. Okay. And then so that's something. So speaking about the market now, so that extra 10,000, which is effectively their interest. You guys are looking at using some of your, because you've got quite a lot of Airbnb units, maybe using the profits from them to sort of pay for that interest as a way to finance that. Because that you're effectively financing your money within the business by your other cash flowing business. Yeah.
So if it was a straight up loan agreement where it's not a joint venture, where there was a clear 12 months, then you have to pay back everything plus the interest within the 12 months, which would have to be financed. If you're buying and holding, it would have to be financed by the another business. So either selling a property as a trading business, so you're flipping properties as a trading business, so that profit will pay for the interest and the remaining whatever that's owed, or the service accommodation business, so that cash flow. So for the investors who are lending money for a property deal on a fixed rate return, so that's like a clear 12-month kind of thing, isn't it? So
it's clearly defined.
It's clearly defined. Say 100k in, 10%, 110 back, whatever interest rate you choose, and then it's clearly defined. Now, when you're refinancing, at the end of that, you're going to come to a point where, right, we still owe another, like say maybe 5-10k if we're refinancing. We have a stuck in equity, but we still need to pay the investor back. So that would either come through flipping properties, or it'll come through a different business that you have, which is cash flowing to service that debt.
Yeah. So something we're thinking of doing, me and my brother, is to use any profit from the first buy to let, keep it within the business to build up to accrue as almost like that's your interest money, and then subsidise it with any money from our jobs. Because we haven't got the cash flow business like you guys have got in terms of the service accommodation thing, but it's a way of, because you're effectively servicing that debt, because that's all that interest is, isn't it? It's a way you're servicing, buying that house. Because that's all you'd really be in for, is that 10%, isn't it? Really, to buy that house. Let's think about it, because if let's say you lend the 110. Well, it costs you the 10% interest to lend that money, doesn't it? So it costs you the 10% interest
Cost of finance, yeah.
to buy that house. So when you think about it like that, that's where it's like, it's the best way when you've not got the money, because you just have to almost finance it. The target is almost how are you going to pay the 10% back.
Yeah, I mean, if it's in the deal itself, I mean, you might be able to find it in the deal if you get a belter deal.
Get the value up.
Yeah, if the value is there, or if you're refinancing and you can refinance enough to pull like everything out, which in today's market is pretty hard. But if you can find that value,
is that because of the purchase price? What do you think?
A lot like below market value deals right now are pretty challenging. So we don't even look really too much at below market value. We more so look at like, you know, where can we add value? You know, change things around to better. Like for example, like that one there that we've in legals at the moment. So it's 2 flats and a little lock up underneath it. So we're adding value to that one by converting it into a higher cash flowing asset. It'll need a bit of a refurb, but the actual the service accommodation cash flow will help increase that value of that property as well. But we are going to get, even on a bricks and mortar value, it'll still be worthwhile. Because the lockup's not currently rented out, so we get a lease in place with that. That'll increase the value of the total building. Yeah. So things like that. But yeah, I mean, if you can find the value in the deal itself to service that debt, then even better. If not, if it means tying up 10k in the deal, then okay, you can find that through either if you're property trading, if you're doing flips, or whatever. So like people like often do flips to pay for those, to pay for the interest on.
Yeah, because let's say you make 30k in a flip.
Yeah.
Well, then there's 3 lots of 10% interest on 100 grand. So you could in theory buy 3 properties with that 30k if you had the investors, couldn't you?
Yeah. Like everyone's deal dependent as well, isn't it? It's like it depends on the investor, what the terms you want. Yeah. Like doesn't even have to be 12 months. Could be a longer term as well if it's a bigger deal. You know, if you're doing like a big office conversion or something like that. Depending on the build team and that, it could be like a bigger project. It might take a bit longer. Yeah. You know, it's all just like any kind of deal. It's like the way I say it is like a blank sheet of paper. Yeah. You can write whatever you want on it. You know. Yeah. You could bend people in on a deal. You could give them a bit of equity as well, a bit of the profit on top. But that's subject to more legislation. Things like start offering kind of variable returns and that. It's kind of more you're down the route of the PS 13.3 legislation where you need to like get people to self-certify if they're a high net worth individual or a sophisticated investor, if they've done deals like that similar in the past. So if you're given like variable returns like that, you do need you can't advertise them the same way as a fixed rate.
There's a bit more to think about, right?
Yeah, exactly. So yeah, it's something to be aware of. But yeah, I mean, as long as it's win-win for everyone, you know, if we're all for making win-wins, it has to be a win-win for everyone. Otherwise, it's not a deal, is it?
Well, and particularly at the moment when inflation's sky high, you know, investors are going to want to put the money to work somewhere.
People there's a lot of people with a lot of money in the bank out there, and it's just dwindling right now. You know, it's getting eaten away by inflation. And then, you know, there's obviously that thing as well of risk. So, you know, a lot of people that have money in the bank, and there is this thing of like, well, do I trust this person with my money? You know, if you're handing over 100k to someone, you're going to want to know what they're all about and everything. You know, you're not just going to hand 100k to anyone. So there's that risk factor as well. There's ways to mitigate it as well. So, you know, if you're looking to borrow money from someone, you know, if you're offering them fixed, like first charge on a property,
which is just basically if anything goes wrong, they get the house.
Yeah, so it's like a bank essentially. They have the same security what a bank would take out, a charge on the property where they've their security. They basically have, and if that property was to ever sell, the person who gets paid back first is the person who has the first charge. So that's kind of like a security in that sense.
So they've got a tangible physical asset. For their money if everything goes sideways.
Yeah. But the way the deal is presented, the money should be in the deal itself. The equity should be like a security in itself. So if you're buying something at a certain price and you know you can add this much value to it, then that and the end value is whatever it is, then that's an extra cushion as well. So it will sell for more. A lot of people like investors and that, like bigger banks and stuff like that, like if you're looking at developments and stuff like that, they want to see the person doing the development to make way more money on it, because that means that they have a load of cushion, so their security is a lot. So if they can see someone like a developer making like 30% or 35% profit on the deal, that's a lot easier to get funded on than if they're only making 15% on a deal. A lot of lenders, they won't lend it anything less than 20% on a development, because it's that risk thing. You know, if that 20% or 30%, that cushion, it's a big cushion. Like things have to go really, really wrong. You know, for things to not work out like that.
30%, yeah. Well, the market have to swing.
Yeah.
30%, isn't it? Yeah. Well, and that's the argument with the 25%, with the 75% loan to value, isn't it? It's like, you know, if you buy a buy to let on that, you know, chances are the market isn't going to drop 25%. You know, if it does, it's like it's pretty bad. But you know, you've got that baked in anyway, haven't you? So
yeah. So it's like that's it. Like, so it's down to the investor, I suppose, to find the opportunity and that, and getting the right deal, and then making it a win-win, really. Yeah.
So you do lots of service accommodation across Liverpool. So Joe and his business partners actually, there's an article in the Liverpool Echo. The owner pub, which you're converting into an SA, and there's a big Ringo Starr mural. Sorry, easy for me to say, on the side of it, which has got a lot of attention, which is good. So what's the story behind that? What are you doing with that?
So that's going to be a hotel, boutique hotel, Beatles themed. The pub itself was featured on Ringo Starr's first ever album cover, Sentimental
Was it
Journey.
his mum who worked there?
His mum worked there as well, yeah. And he grew up on the street just down from it. So.
And where about in Liverpool's that?
So it's in Toxteth, so Dingle. It's the L8 part, High Park Street. Yeah. Gets loads of attention. There's all these tour buses that stop off every single day, taxis, tour cycles, that kind of thing. So it should be up and running by the summer. So it's got loads of attention. Yeah. But again, another thing in adding value, like colour, like having that splash of colour on the street, has probably not just increased the value of that property, but every other property on that street, because it becomes like a more kind of, it kind of gives it a hip, kind of desirable kind of vibe. It colours the street up, it makes people feel good. So it's a creative way to add value. If you have like a big building there, just throw a bit of colour on it, and it'll brighten up everything. So
and it's happening to the historic. You know, it's almost getting a value from the historic story behind the building and the area, which is a good thing. Nice. So then you've got that, and then you're also looking at sort of branching out into like an SA management sort of business, aren't you?
Yeah. So that'll be our trading thing. So the SA management in Liverpool right now, we're going to do that for other clients as well in Liverpool very soon. People buying properties here, they have some bad experiences before with tenants not paying, and they just want a bit more control, maybe a bit more profit as well.
More money,
so they look at service accommodation. So we're going to start doing that for other investors and landlords in Liverpool, along with the cleaning as well. So we have our in-house cleaning team and the laundry as well. So we're setting up some semi-commercial washing machines and dryers below us in this office.
Yeah, in your office,
So they'll be doing that all in-house as well. So basically making it a turnkey, business for investors. Yeah. So that's the plan with it. So between that now and our purchases here in Liverpool, the investors we work with, joint venture partners, we're looking to expand that a lot more this year as well. We're looking more so towards the flats, the blocks, like maybe 2 to 5 range, 2 to 5 flats, maybe a bit more. Commercial conversions, that kind of thing. So we're actively doing that at the moment, and looking to expand that side of it as well, along with a few other bits on the Wirral as well, like that HMO, 2 HMOs there, but mostly kind of just the blocks and stuff. But our exit strategy primarily is serviced accommodation at the moment as our first exit strategy, as our primary exit.
Nice. And if people want to get in touch with Liverpool investing,
you can check me out on Facebook or LinkedIn. www.inserviceproperty.com is our website. Nice. If you want to find out a bit more about us, check out inserviceproperty.com. Tells you a bit about my story, my business partner Mark and Justin's story, and our plans going forward and how we can serve you.
Yeah, nice. And I'll leave that info in the description below, because these are definitely some of the most prominent guys in Liverpool. So if you want any questions answered about Liverpool, speak to these guys. But